So please welcome Mr. Dave fucking McClure.
Awesome. I have a band to back me up. That's fucking great. Good morning, Madrid and other folks. I was out having whiskey about 2 a.m. last night, so I'm not super thrilled about having to get here in time, but thank you guys for showing up. I'm going to talk a little bit about what we see as changes are happening in venture capital, both from the entrepreneur and the investor side, and how that impacts building startup ecosystems, not just in Silicon Valley, but all over the world. In particular, I want to explain what I think is a different way to do investing that can be applied to global markets. We call that kind of lean VC, but it's a more quantitative approach to venture capital. We'll also talk a little bit about why that's helpful in building global entrepreneurship systems. So my background, I started out as a geek. I've been in Silicon Valley for about 25 years. First, I was an engineer. Then I was an entrepreneur. Not a great one. I had a relatively small exit for less than $1 million. Had the good fortune to end up working at PayPal between 2001 and 2004 and met some pretty amazing folks over there. Was mostly doing marketing or geek marketing at that time. And then started doing angel investing as I was leaving PayPal. I've been doing a combination of angel and VC investing for the last 10 years. Worked again with Peter Thiel and Sean Parker at Founders Fund before starting 500 Startups. So what is 500 Startups? We're a global seed fund and accelerator, a little over 100 million under management. About 35 people, 12 of whom are doing investing. We've done a few investments. We actually have made over 800 investments over the last 4 years. About 75% of those are in the US, but about over 200 companies are outside the US, spread across 40 countries. And our team is pretty global as well. About a third of the team wasn't born in the US, and we speak about 20 languages. I'll explain later why I think that's important to our strategy. We're still pretty young as a venture capital fund, but we've had about 4 exits that are over $100 million and some other companies that are doing well. With a little luck, we might make some money. I mentioned we're in a bunch of different places around the world. Several people on our team are in Brazil, Mexico, India, China, Southeast Asia, and Indonesia and Malaysia, and we're working on people here in Europe as well as the Middle East. So I want to focus on some things that I think are changing in tech, many of which you probably are already aware of, and a few you may not have thought about quite as much. So these 2 big bookend events that happened around 2000, 2001, and 2008, those were very large dislocations in the financial markets, not always caused by technology, in fact, particularly more caused by real estate and the IPO markets. But they had a pretty big impact on how startups were financed, and there were some changes that happened in what the startups required both before and after that. Many of you are probably familiar with the lean startup movement, Eric Ries and Steve Blank and others. I think in general we're recognizing that there's a better way to be building startup businesses. Some of that you might call scientific, some of that might still be a work in progress. But at the very least there's a significant reduction in capital cost in building companies, at least in the first few stages. There's also a lot more people online and easier ways to get to them than ever before, mostly via search, social, and mobile platforms. We still have some work to do on payments infrastructure and delivery and logistics, but that is getting better in most countries. And we have these global platforms for fundraising, or at least some platforms that are starting in the US and Europe and maybe spreading to other places, like Kickstarter and AngelList. And then I'll talk a little bit about some changes on the investing side. Some of these started happening maybe even 10 to 15 years ago, but a lot of them have really happened just in the last 5 years, particularly with the growth of accelerators around the world. Some of that is bad, some of that is good. We'll explain why. Okay, so first of all, big changes in tech startups that probably started happening in the late 90s, early 2000s. Really dramatic cost reduction. Particularly Amazon Web Services and other cloud-based services have reduced the cost of software development, provided a lot more plumbing and infrastructure to build companies. We also have large numbers of users online, platforms with over 100 million people, in some cases 1 billion people. Again, those are mostly search, social, and mobile, maybe Google in the developing, in the US and Western markets, Baidu and others in Chinese markets. We have mobile platforms that really didn't exist very long ago, which now have hundreds of millions again, or billions of users. And we have changes in how we build companies that are a lot more efficient in terms of capital. Those might be incubators, those might be angel investors, might be other crowdfunding platforms or seed funds. So let's take a look at what the world used to look like maybe 15 years ago and then maybe 5 to 7 years ago. So before the year 2000, how do we build startups? Even in Silicon Valley, we kind of had a large cost expenditure. We might be buying hardware, software, things that basically cost millions of dollars, and probably at least 2 or 3 million, maybe even up to $5 million were put into companies before they got to market. And it might take 2 or 3 years to get to market. So we had a lot of challenges in building those companies that were very constrained to certain types of businesses, probably mostly enterprise and business-related customers. The sources of capital were really constrained around probably places like Boston and Silicon Valley, maybe a few places here in Europe. In general, this is what I call the big fat dinosaur startup. It was not very efficient. It took a while, but there is still a ton of enthusiasm in Silicon Valley for building startup businesses. The reason I mention this is because today when people are talking about businesses, building startups all over the world, there's a lot of complaints that I hear about access to capital, lower valuations, different challenges. There is no greater challenge anywhere in the world today than what it took to build a startup in Silicon Valley 15 years ago. So just for looking at those like sort of scenarios, it was harder for the best Stanford-based engineers and entrepreneurs with access to venture capital 15 years ago in Silicon Valley than almost anyone today that has basically a pipe and some type of computer to do development on. You have dramatically greater access to customers, dramatically reduced costs. You may have some challenges still in raising capital, but you don't need nearly as much capital to get those businesses off the ground. What did the world look like now after 2008 and after the last financial crisis? All these publicly available cloud-based services, Google, PayPal, Facebook, Twitter, Amazon Web Services, all sorts of cloud and open source software, things that you really don't have to pay much for. Most of the costs of building companies now in the first year are really just the cost of paying for people building the product. Engineers, designers, maybe some on the marketing side when you're starting to build customer acquisition. That's where you might start seeing some substantial amount of expenditure. But still, for a lot of companies, you can build the initial product in maybe as few as a couple months, probably not more than a year, and your costs are measured in considerably lower than maybe $1 million US, maybe even just in sweat equity for people building those products. There's a much greater number of people online, much broader sources of capital, and they're starting to be all over the world. Still more to do in a couple of areas, but it's a lot easier to build startups all over the world than ever before. In particular, the thing that's really changed a lot, not just the reduction in cost, is access to customers everywhere. And pretty much really everywhere. Even in places like Africa, there's many people who are now online, not always online constantly and not always using smartphones, but their access to services online is greater than ever before. You can probably reach at least 2 or 3 billion people on the planet via apps and web services. In another few years, you'll probably be able to reach most of the rest of those folks. You're probably familiar with a lot of the applications that I've listed up here, or the logos from them, but particularly on the right. WeChat, WhatsApp, Line, and Kakao, services that did not exist much more than 3 to 4 years ago, hundreds of millions of people. And not just free-based apps, services like WeChat now starting to monetize as well. In China, David Marcus, who was poached from Facebook, now working at WhatsApp, poached from eBay and PayPal, working for Facebook on building monetization through WhatsApp. So one thing that I do want to mention, AngelList is a platform for discovering startups. Whether you're in the Silicon Valley or somewhere else around the world, it's pretty much the first reference and resource we as investors are going to look at to find out more information about your company. There may be other parallel services in different markets, but as far as we're concerned, full disclosure, we're an investor in AngelList. AngelList is a defining standard for how we look at startups around the world, how we understand who's running them, what kind of metrics are going on with them, and also the other investors that we might work with to build those companies. So let's take a look at what we think about in terms of investment and really applying some lean startup principles to investment. One thing that I say is just the basic story is really make a lot of little bets. In other words, instead of making 1 or 2 investments at maybe a couple $100,000 or $500,000, probably we'd recommend making 10 to 20 investments at maybe only 25, 50, or 100,000. Why is this the case? Aside from all the other goodness and light that I mentioned, startups are still hard, and most of them still fail. So when you have a large percentage of startups that are going to fail, the natural reaction is to do many of them and then follow on invest in the ones that actually start working. We call this strategy lots of little bets, sometimes call it Moneyball for startups. And what does that look like? When we're investing, we might have hundreds of companies in an investment portfolio. This is different maybe from traditional funds that only have 30 to 50 investments. We're going to invest in 200, 300, maybe even 400 companies. And we're going to assume that at least half of those investments, maybe even up to 80% of them, are not going to work. And for us, maybe not going to work means a different thing than for the entrepreneurs, but we would look at that as don't return more than 1x in capital. From our opinion as investors, probably less than 1 out of 7 and maybe as few as 1 out of 20 of our investments really result in material returns. So perhaps only 5 to 15% of our investments really result in big outcomes. For us, that might be $100 million outcomes. For other investors, it might be billion-dollar outcomes. So given that our success rates, at least from an economic standpoint, are measured in perhaps single digits, we want to make a lot of investments early to see how those experiments are working, see if there's customer usage, if there's revenue, if there's any type of positive unit economics, if there's an opportunity for that company to scale, and then maybe we'll double down on perhaps a third of those, maybe we'll write a third check for half of those. But eventually what we're looking for is about 5 to 15% of those initial product and marketing experiments to result in some level of success, whether that's in terms of users, revenue, or other investors. Pretty predictably, when we're doing at least 100 investments, we know we're going to get some number of those large outcomes. The difference is when success or really outsized success only happens 5% of the time. If you're only doing 5 to 10 investments, 5% of 5 to 10 might be 0. 5% of 20 might be 1, but once you start doing hundreds of investments, then you're going to get a predictable number of outcomes. If the outliers that you're looking at are billion-dollar outcomes and only occur 1 to 2% of the time, guess what? You're going to need to make hundreds and possibly multiple hundreds of investments to have a realistic shot at getting that extreme outlier. So how do we go about trying to find that extreme outlier rather than just like, putting money on a roulette wheel and hoping that we're going to get that 1% unicorn outcome? There's a process for doing this. Right? We think about it in terms of product, market, and revenue. At the incubation stage or the product development stage, there's a couple of things we're trying to validate. One is just whether customers use the product. From an investor standpoint, it might be even that, can the team build that product? Once we get some amount of customer usage, do we see that scaling, and is it working on an economic basis? And then once we see scale, can we put money into that company and really aim for growth, revenue, or profit? So looking at each of those, in the investment stage that we're first talking about, this may require actually $0 at all. It might just be a couple of geeks, guys or girls working in a garage and building a product, and they may be able to do it bootstrapped. For some of those guys and girls, they might actually come into an accelerator environment and work on their product for maybe 3 to 6 months. Sometimes they'll come in with product, sometimes they're still building it. But our basic goal is to get some kind of minimum viable product, MVP, and that's demonstrated by someone using it. Now, it may not be a lot of people using it, but hopefully it's someone other than your mom. Hopefully it's more than 1 or 2 people. But it might be only 5 to 10 enterprise customers. It might be only 50 to 100 small businesses. It might be certainly a lot less than thousands or millions of sort of consumer customers. What we're trying to figure out is, can the team get product out? Does someone use it? And hopefully does someone use it in a way that indicates they're going to use it more than once and they might pay for it. Now let's say that like 1/3 of those experiments get to a stage where they're more interesting, and then we're going to switch to a different type of building company. In the first stage, we're trying to test for a set of product features and a set of market demographics that are interesting, right? Some number of people who look like X, Y, and Z. Moms with 2 kids in metro areas that speak Spanish and make between $25,000 to $50,000 a year. Do they want to buy your product? Great. Now let's see how many of them are going to buy that product. How many of them can buy it in such a way that you're making a profit, and how quickly can you scale that growth? What channels do you find those customers on? So a lot of our techniques when we're building the market testing is not based on building features. It's really trying to understand a financial equation between the cost of customer acquisition and the revenue that generates, whether directly or indirectly, and the timing of that revenue and expense. So do I have to spend a lot of money? Maybe building an e-commerce company, I might have to hold inventory. I might have to pay $20 to develop a customer. Maybe that customer generates $5 to $10 on the first transaction, and only after the 3rd transaction do I actually cover enough of my cost that that's a break-even customer. Now, it might be that I don't have any unit economics to work with, and I'm building a product that's for free use, But personally speaking, I'd love to understand the business model and the financial equation, at least with some understanding of where break-even unit economics occur. So in a lot of cases, this stage of development is not so much about geeks and lines of code and really building amazing product. It may be a lot more about understanding the financial structure of customer acquisition, the marketing campaigns and demographics that you're going after, and really trying to build a hypothesis around what cost structure and timing it takes to generate revenue. If we believe that many people start using it, and maybe some of them even pay for it, then we advance to the next stage. Right? And in this stage, now we're really going for some type of growth. That might be user growth, might be revenue growth, might be profit growth. Particularly if you're an entrepreneur that is not raising capital from the markets, you may want to validate that you've got a profitable business that has cash flow positive unit economics in a short period of time, maybe on the first transaction or maybe in the first 3 to 6 months. But at this stage, now we're putting serious dollars into the company, millions, maybe tens of millions. And we're really trying to scale the organization, and we're trying to build a big business, hopefully one that might get to an IPO or at least get to a large acquisition. So these are kind of how we think about building companies now and from the investment standpoint. We're looking at this product, market, and revenue staging. At product, small number of people and small number of dollars, really experiments around usability of product, and maybe just a small number of customers. The next stage, we're trying to look at how can we scale usage in a way that's hopefully profitable. And we might be looking at the financial economics, what type of marketing campaigns we can use, what type of channels, again, looking at those search, social, and mobile channels, maybe even other channels that might involve video, other types of content. How do we scale that audience, and does that look like it might be profitable, at least at some point in the near future? And then, how do we really go for broke? How do we really grow a big company? And this may only happen in 10 to 20% of those early cases. It may only succeed in a small number of percentage, maybe only 2 to 5% of those initial cases. So as much as startups are easier to build than ever before, the odds are still pretty much stacked against building very, very large businesses. Now, this is the type of business that everybody salivates over. Entrepreneurs, investors, we're all trying to figure out how we're going to build the next Facebook, the next WhatsApp, businesses that really have had pretty huge price tags around them. But that's not usually the type of success story that we're really going to end up looking for here. In most cases, it's really businesses that we understand with some type of economic model and maybe scale to tens of thousands or hundreds of thousands of users. But in our opinion, businesses that are maybe generating $10 million in revenue and up from there are interesting enough to want to finance. For different venture capitalists, that may be a higher price tag. So that's really a different way to think about building startups and financing startups than ever before. And in a lot of history, venture capital has pretty much been a crapshoot where we're investing a lot of money on what we think is a very smart team with hopefully a breakthrough product. And for a lot of those types of investments, we're really gambling. We're just throwing money away, very large sums of money away on a small number of samples. This, we're not doing that. We're actually starting with a really large sample size, relatively small amounts of capital for each of those product experiments, and as those companies get to higher levels of success, then we add another zero, then we write a bigger check, and hopefully we're not wasting as much capital on the states of failure that occur as frequently in the beginning. So how does that apply to building startup ecosystems? Well, I'll tell you, a lot of people think they're trying to copy Silicon Valley and build it all around the world. Now that's a bit of a challenge. Silicon Valley has probably had a 50-year head start on the rest of the world. There's multiple generations of successful entrepreneurs, high density of venture capital, high density of talented people coming in that are either going to schools in the Bay Area or working for lots of companies in the Bay Area. There's a tradition of entrepreneurship and investment that has been happening for arguably 50 to 70 years. Now, that's not easy to build overnight in other places, but the advantages are that the costs and timing of doing all that work over the last 50 to 70 years can be compressed. In particular, the amounts of capital required now to build those businesses in other geographies are much, much less. The critical factor, though, is really what I call optimism and belief, almost insanity in a way, institutionalized insanity. In Silicon Valley, probably not more than 5 to 10% of people have some big type of success. Only 1 in 10 or 20 really have a big success story. And yet, we think it's going to happen every time. Entrepreneurs think, oh, it's definitely going to be me. Yeah, there's lots of people going to be failed, but it's that person, or it's that person, it's not me. There's a suspension of disbelief that basically means that we all think the other person is crazy, but we're going to be the one that's actually going to win. Now, that may result in some bad market economics. There may be people who are investing too much money or trying stupid shit all the time, but that is what is required. If success only happens 5 to 15% of the time, if we are practical and logical and business MBAs, what the fuck? We would never start businesses. We would never do it. There's a required amount of insanity that is actually essential at the elements of what Silicon Valley is, whether that's a place or a state of mind. It's institutionalized insanity against the odds that I'm going to make it. You're going to fucking fail, but I'm the one that's going to succeed. Now that's kind of crazy, and that's what's essential, both on the entrepreneur side and on the investor side. Now the challenge with that is you can't fail all the time. You need some success points to actually make that insanity worth being institutionalized and sustainable. So it's okay if you're that crazy that 1 out of 10 or 20 actually have a 50x or 100x outcome, either in terms of success, economics, or whatever you're looking for. From the investor standpoint, that's also true. The investors actually have an easier time. Entrepreneurs usually have to do 1 sample at a time, probably at least a couple years. So if I, as an entrepreneur, want to have 10 shots at the plate, guess what? You're probably talking about 10 to 20 years to see if you can actually have a portfolio of approach. As an investor, I can do that in parallel, or at least I can do it over a very short period of time. If it takes 20 shots, 10 to 20 shots to have a decent chance of getting a big win, I can do that as an investor in 1 to 2 years. Now, I can't do that by investing all of the dollars that I have. So a lot of investors who come from more traditional markets, particularly real estate and others, they generally think that, oh, I'm going to look for a very conservative approach. I want to see traction already. I want to see sort of growth in numbers. That's not how startups work. You're not going to see the success levels of actual substantial revenue and probably not profit for at least a few years. And your opportunity to invest is before that actually occurs. Once those companies are growing profitably and making money, guess what? They're going to be expensive for investors to get into. So while all these other pieces, people, infrastructure, product, customers, etc., I'll talk a little bit about exits and why that matters. Really what you want is an approach that's going to have a diversified attempt at building startups really over a sample size of at least 20. So when we look at how that startup ecosystem plays out, there's lots of participants now that are starting at the very early stages. So angel investors, accelerators, seed funds, even just crowdfunding platforms. There's a lot of new sources of capital that 5 to 10 years ago really did not exist at scale, really did not exist in many places around the world. And there may still be challenges in finding Series A capital, and there may be certain locations where larger venture capital isn't always available. But actually, if you get to a decent-sized business, larger capital probably is easier to find in most places. What's really still challenging is the amounts of money that are probably greater than 100,000 and less than 2 million. There's lots of crazy people who will write $10,000 to $25,000, maybe $100,000 checks. There's not so many crazy people ready to write $500,000 to $1 million checks. That's really where there's a substantial gap in the market. There's not really as much proven economics around the businesses. There's a lack of expertise in understanding how to invest in technology businesses. And particularly what I was talking about, a diversified approach at investing, not really comfortable for most people coming from real estate. They're going to make 1 or 2 investments a year, maybe at a large dollar size. Probably those will fail, and they'll probably say, this tech investing thing is just bullshit. It's not going to work. Right? Now, they're right in the single sample size case, but they're not right when you start looking at 20 investments. So here's how we think about building a startup ecosystem. You may have 1,000 crazy entrepreneurs who really have no idea about how to build a business. They may not be even able to get product out the door. They may not be able to hire or do the engineering or the design or the marketing to get those companies, but they're at least crazy enough to try. And that, again, is essential. We should not shit all over the attempts of crazy people in an ecosystem just because their ideas are crazy. They are an essential element also of getting people to jump in. We just have to recognize that most of them are stupid and crazy and will probably fail. And by the way, I'm talking about you. So now 1/3 of those crazy people may have enough talent to get a product out the door, may actually get into some type of accelerator program or get a small amount of funding, and they may be able to get some amount of customer usage. And from those set of people, okay, then another third might get to what we consider seed stage startups, where they really got a product, maybe have a market, possibly might be making money. And then from there, we start to see the venture capital really approach. And I'm sort of presenting a model where 1/3 of each of those kind of groups progress to the next stage. That may be off, But in order to get to mature company IPOs or really large businesses, we're probably talking at least in terms of hundreds and likely in terms of thousands of companies that you have to start with. So people who are sitting around waiting for talented entrepreneurs, waiting for really big businesses to emerge, that's not going to fucking happen. You're not going to get to the big IPO kind of businesses unless you do the work to build the ecosystem and have the shitty little businesses that are full of idiots and fail constantly, to have a few set of people who actually succeed at getting to product viability, to get to customer viability, to get to positive unit economics, get to scalable and retained use that happens on a frequent basis, to get to financeable businesses, and then get to large possible outcomes that might be bought by other companies or taken public. This is not rocket science. This is a funnel from a typical startup perspective. It's just looked at from the investor-entrepreneur perspective. We need to start with lots of little bets in order to have a chance at a few big wins. So on the entrepreneur side, how do we think about making that stuff happen? Well, I'll tell you what, it doesn't happen from fucking business plans. Business plans in general are a piece of theater written by people who are predicting a very unlikely future. Business plans generally are static predictions of 2 to 5 years of outcome at less than 10% likelihood. Why the fuck should we believe in that? What utility does that have for understanding how to build a product in a market that you have little understanding of? Most internet businesses are an attempt at a hypothesis about product and a hypothesis about customer usage and maybe some mumbo-jumbo of what the financial aspects look like. It's very likely wrong, and it will have to change constantly. And how do we test those hypotheses? We do lots of little experiments. We do marketing experiments, we do product experiments, we do some customer usability, we try and see whether the economics work, we change the prices, we test a lot of things. These are not static. They're not written on a piece of paper. They're product prototype experiments that we push out into the market and we see whether they work or not. I think someone will click this button. I think someone will pay $10 for this. I think they'll come back in 3 months and buy again. Guess what? You are fucking wrong about all three. And you'll have to change that. So writing a business plan about I'm going to hire 10 engineers, I'm going to have these marketing channels, I'm going to have this other thing happen, I'm going to be making lots of money. Guess what? You're fucking wrong. None of those things are going to happen. This hypothesis that you made back here was wrong. So why are you building an outcome that's based on 10 different low probability hypotheses? You're full of shit. That is not how you build an internet business. You take a scientific approach. I take one step. I hypothesize. I will get customers that will convert to some level of usage at a level of 10%. It wasn't 10%. It was 5%. Let's change the marketing copy. Let's put a picture of a baby up there. Okay, we got a conversion rate that went to 12%. Great. Let's take the next step. Can we see if there's another product that a customer might want to buy? Can we send them an email that will get them to come back? Can we change the title on the email? Do we change the picture or the color of things? These are a series of tests and experiments where it's much closer to science than marketing. Than this theater that we call business plans. So the essential elements of what we as entrepreneurs should be investing in are functional prototypes. Excuse me, I'm getting a little excited. How you doing? The essential elements of these business plans, I'm not saying business plans are complete bullshit, but they're just very low probability predictions of the future. What we want are actual testable hypotheses and evidence that our hypotheses make sense. And when they're not making sense, we adjust. And then we test again. And we continue to develop these hypotheses until we see that there's functional unit economics and functional customer adoption that start to be interesting. Hopefully, in some of that, we actually start to make money, we grow the audience. From the investor side, number one point, startups are not real estate. Stop acting like they are. Real estate probably isn't even real estate. You think you're going to make money on real estate. You think 80% of those investments are going to go up every year. Guess what? You're fucking wrong. Particularly in Spain, I think you probably agree with me right now. So rather than thinking about investments as one investment likely to have a 70 to 80% chance of rising, we think about startups as mostly they're going to fail. 80% of our investments in startups are going to fail, and a very small percentage of those startups will have outsized returns. Again, if success only happens 5 to 15% of the time, guess how many investments I need to make to have a real shot at success? At least 10 or 20, probably more like 50, at least for the really big outcomes. So a power law approach is true. You're going to have lots of asymmetric outcomes and winners, but you need to have a large enough sample size to catch one of those big winners. There's many other things that are really important to think about from an investing standpoint, but the biggest one is just making lots of little bets. and then trying to understand if you're going to have a shot at success, potentially that you save some of your capital for the follow-on investments after you've filtered out early failure. So now let's think about, like, if that's what successful ecosystems look like, what dynamics actually might work globally? Well, historically, a lot of things only worked in English-speaking markets, only worked in Silicon Valley, only worked for a very specific type of business customer. Those were mostly due to density issues. I didn't have very many other customers that weren't businesses. I didn't have a lot of customers that weren't high GP, that weren't speaking English, or at least in Western European markets. That has changed. Lots of my customers are now not business. They're certainly not even large business. Lots of those customers speak other languages. I have high density of people and usage in many places around the world that you wouldn't expect, some of them in Africa, some of them in Southeast Asia, some of them in the Middle East. In particular, we think there's probably 4 global languages of interest. English and Chinese are obvious, but languages like Arabic and Spanish, not so obvious, still big markets. Probably 10 to 20 other languages that are interesting from a size of country standpoint. Now, there may be lots of challenges in developing these markets and figuring out investment in these markets, but most of the macro picture is extremely positive. Smartphone penetration rising, internet penetration rising, probably average consumer GDP rising, at least of a large percentage of the middle class. Other types of economics around delivery, logistics, payments, all going up and to the right. Nothing of those things are usually bad. Even in markets where the macro picture for financials maybe isn't so positive, most of the time e-commerce usage and internet usage are strongly up and to the right. So your bet on international markets usually is not going to be any worse looking forward. You may still fail today, but your investments tomorrow are probably going to have at least as good or better chance. Now, you might suggest that that's a reason for waiting. I like to think that's a reason for getting started right now. Every time I'm making a bet in international markets, I'm betting on a future that's more positive than today, and I've got hard data to show that that's likely to be the case. Lastly, you won't be able to read all this, but I'm going to leave you with one kind of point that I want to make. Our company is called 500 Startups. We've actually already made 850 investments. Within another year or two, we'll probably be doing 500 investments a year. Why am I so positive about that belief? My belief is that if we think about entrepreneurship or the people who are crazy as people who could build maybe a $10 million business, maybe employ 50 to 100 people, I think that's maybe 1 out of 100 people. It might even be more. But my belief is that at least 1% of humanity is entrepreneurial in that direction. There's 7 billion people on this planet. The number of great entrepreneurs and great companies is measured far more than 10 per year or 100 per year. There are hundreds of thousands, arguably potentially millions of people around the world who can create great businesses every year. We want to have a chance to fund all of those people. If we only looked at markets that were the top 100 global metros and the top 1 to 2% of those people building businesses, it would still be tens of thousands of bets every year. At $50,000 to $500,000 per person, we're talking about billion-dollar opportunities every year, billions of dollars of opportunity every year, and it's only getting better. So we're big believers in talent globally, developing that talent globally, markets globally, and we're getting started on that right away. I hope you'll join me on that journey. Thank you.
Thank you. Sorry for making you wake up so early.